In our cover story, the three-ring circus of panic that brought the collapse of Lehman Brothers 5 years ago and a $700 billion bailout known as TARP for Troubled Asset Relief Program led to change. But how much has been implemented, and is it enough to prevent a financial crisis from happening again? At a conference in Paris this week, banking interests assessed progress toward making credit default swaps more transparent.
For people who use these, they're going to get some pre-trade transparency. They can see prices, figure out if they're getting a good deal, and if they got a good deal afterwards. On top of that, we're building trade repositories to store this data so that we can see what sort of risks are contained in the system.
Analysts say credit default swaps provided a form of insurance on risky mortgages and encouraged lending to borrowers with poor credit before the housing bubble burst. Then in 2008, the phrase too big to fail became synonymous with an economy held hostage. It led to Wall Street reforms under the Dodd-Frank Act, restricting banks from overextending themselves.
The banking industry is far more capitalized, well capitalized, than they've really ever been before. And that's both with regard to the amount of capital that the industry has, as well as what you might call the quality of capital.
But others warn that Dodd-Frank's intent is being picked apart in the rule-writing process, that regulators are too closely tied to the banking industry to support tough legislation, and that government policies encouraging home ownership have not changed.
Yes, banks have gotten more risk averse. It's harder to get a loan now than it was in 2007. And I think it's probably a good thing. I mean, you want to be able to pay back a loan if you're going to take one out. So there's nothing wrong with that. But because of the fact that the government is still in the business of manipulating and subsidizing the housing market, I think the kind of root cause of the crisis of 2008 could bite us again 5 years from now.
Though Dodd-Frank reform was approved 3 years ago, a lot of the details remain unspecified. As of this month, 40% of Dodd-Frank rule-making deadlines have been met. 61% of the deadlines for reform have been missed. And about 32% of rule-making requirements have not yet even been proposed.